Well, hello, ladies and gentlemen, and welcome to this discussion. I'm Mark Dunn, and I'm the editor of Portfolio Institutional magazine. Yeah. I'm going to be your host for this discussion for the next, just over the next hour or so. And the topic of this debate is responsible investing. This has been a big topic in recent years. Once considered niche, the idea now of making a return on investment while at the same time making some kind of environmental, social impact is now, and there's a very strong argument to say it's now a very mainstream strategy. And I don't think there's ever been a better time to discuss this particular strategy because we're in the middle of a pandemic. There seems to be quite a deep recession if we're not there already. And of course, when the pandemic is nothing but a memory, that our world will be changed in some ways. It's interesting to hear about that. As well as this, of course, if we look at what's happening around the world with the sort of demonstrations and protests, it really is changing how governments, companies and organisations are reacting to that and how they're thinking. So this is quite a big time of change, 2020. Before we start, I think it's always good to let us know exactly who's put themselves in my hands for the next hour or so. If we just have a brief introduction of who we are. Matthew, if you could just start with yourself.
Yeah, morning, I'm Matthew Cox. I'm the investment director at the Esme Fairbairn Foundation, which is a £1 billion foundation based in London. We give money to a variety of causes in the UK.
And your grant base is now?
Yes, we give about £45 million a year in the areas of the environment, social change, young people, relatively diverse. And we also have a social investment fund, which is smaller, which has been going for more than 10 years now.
Okay, thank you very much. Helen.
Hi, I'm Helen Price. I work for Brunel Pension Partnership, one of the 8 local government pension scheme pools. I'm the stewardship manager at Brunel, so I oversee our voting and engagement and interactions with our asset managers and the different initiatives that we work with.
Gotcha. And Daniel.
Hi, I'm Daniel Satter. I'm the Chief Exec of Big Issue Invest. We're a direct impact investor, and we invest, we've probably got about 75 million directly invested in charities and social enterprises across the UK, about 200 live investments at any one time.
Gotcha. Thank you. And Aaron?
Hi, I'm Aaron Pinnock. I work for the Church Commissioners for England in their responsible investment team. The Church Commissioners are the endowment fund of the Church of England.
Gotcha. And last but not least, Richard.
Hi, I'm Richard Tomlinson. I'm the Chief Investment Officer at Local Pensions Partnership Investments, which is one of the local government pension scheme pools. We manage around 18 billion on behalf of 3 local government pension schemes.
Okay. Thank you very much for that, guys. Actually, Richard, if you could stay with you, can you just tell me exactly what the big responsible investment themes that your team consider when making an investment?
Sure. So the way we approach responsible investment is to take an integrated approach. So we very much think about it from an end-to-end basis, full life cycle of investment across multiple dimensions. And the way I would frame responsible investment for us certainly is we're very much on an integrated basis, but we are, I would lay our we're not an impact investor. We are clearly, our primary responsibility is our fiduciary responsibility to deliver returns to our clients in the sense of their primary responsibility is to pay pensions as they fall due. However, we have public sector stakeholders, and the journey I've been on personally is to then on an RI journey, essentially, because the way I would now frame investing is that it's a core plank of an investment process, irrespective of your call it ethical or whatever you want to call it philosophy. It is absolutely critical to delivering long-term investment return, and we then take the view that that is core to our mission, layering on top the views and beliefs of our clients and our own. But as I say, I certainly come at this as an investor, but the integration of RI into our process is absolutely critical now, and it comes in at multiple levels, from an investment underwriting, through monitoring, through how we engage with all of our assets, and it's multifaceted. But the way I would frame where we are, this is a journey. There is no end point. We're on that journey. We are certainly in that integration and engagement camp, and it is something we take very, very seriously. So certainly we have there are things we will pass on that we won't do based on RI or ESG concerns, and we will engage and we will talk to whether it's managers or companies regarding these key issues. RI team, to give some context, so our investment team is around about 35-40 people, give or take. 4 of those are in our responsible investment team. So you say it's 10% of our headcount. So it's a material part of the team, and it's something that I am now involved in very deeply. And I say, to me, if you'd asked me 5 years ago how important is RI to the job of chief investment officer, I would have said, well, it's kind of something you might look at. Now, I don't want to put a number on it, but it's a core part of my responsibilities and a material amount of my time.
Gotcha. And Matthew, the same question to you. What are the big RI themes for you guys?
Yeah, sure. So all our endowment is invested with external managers, and Richard, we've generally been trying to make incremental improvements year on year. So that's involved exiting managers who aren't looking at whether their holdings might be aligned with our mission. We haven't gone down the route of excluding specific stocks, given that we're indirect investors in funds, but we've tried to come up with a fund selection process which minimises as best we can managers who are likely to buy stocks that conflict with our mission. And then so it's a mixture of exiting funds which aren't doing what we'd like, and also looking for positive investments. They can be thematic, or they can be any manager with a boutique approach who's looking at stocks. For example, climate solutions is a big financial opportunity at the moment, we believe. And then on top of that, we've been gradually doing engagement alongside working with our investment advisors. So this has included signing some letters direct to companies. We do grant funding, for example, on improving food systems in the UK, food waste. So we were approached by another investor, asked if we would join a coalition writing to a series of food companies in the UK and trying to engage them as shareholders, which seemed very aligned with what we were doing on our grant making side. But we're still very much, we're certainly not getting it right all the time, and we're trying to be quite open about that and hope that where we learn mistakes, if we can share with others, then it will help them to begin this process as well. Longer term, the concept of having a portfolio which is net zero in terms of carbon, where there is it's now in law in the UK, given we're an environmental fund, and that's something which is high up the agenda at the moment. And then alongside that, we have our social investment fund, where we look to get our money back. So the return, we're happy to swap financial return on that fund for increased impact. And that's allowed us to work along a spectrum of capital, if you like. So grant funding at one end, where we will never see the money again, to social investment, where we will get our money back, through to the endowment, where we look to make a market return to fund all our operations and our grant making.
Okay, thank you, Matthew.
As Richard said, it's been a journey, yeah.
Yeah. And Daniel, we're in a recession, expected to be quite a deep one. So what does that mean for a social investment bank such as yourselves?
Yeah. I think I mean, on recession, we haven't experienced a high unemployment recession for a couple of decades. We kind of ducked that out of the global financial crisis, thanks to the gig economy, and also thanks to the sacrifice that ordinary workers took. People didn't get a real term pay rise. So we're coming into tough times. I think the thing about the charity sector and the social enterprise sector is it is extraordinarily resilient. Charities and social enterprises tend to go bust less than other small to medium-sized businesses. So our portfolios are actually performing reasonably at the moment. I always hate to kind of say things are going okay, they're not. But we've got about 10% of our small loan portfolio is still off schedule in terms of payment. That was about half when we hit the worst stage of the lockdown. And we've had no failures on our larger investment side. So I wouldn't be surprised if we're not outperforming in terms of business failure, simply because of the extraordinary resilience of the charity sector. And we have something where people volunteer their time. People will do anything. to try and keep their charity and social enterprise going. So it's pretty grim out there, but I suspect we're not the worst hit.
Gotcha. Okay, thank you for that, Daniel. And Aaron, you're an impact investment analyst. So where do you think the need is at the moment for investors to make an impact?
Yeah, sure. So the Church Commissioners, well, I joined the Church Commissioners about 2 years ago now, in this newly created impact role. Now, the Commissioners, we've always been, for many years, we've incorporated what we see as a full suite of RI tools, responsible investment tools. But like Richard and Matt said, it's a journey. And so the impact the impact investment scene has kind of grown over the last 5-10 years or so. And there was a realization within the Commissioners that in order to remain being at the forefront of responsible investment, we needed to embrace the idea of impact investment and impact management and investing for outcomes. And so that's kind of the core focus of my role, and also now what we're kind of transitioning to within the responsible investment team. So we're looking at how we can use our money to enhance real world outcomes for society and the environment. And I'd say probably where the bulk of our attention at the moment in the impact space is on climate. Though that said, being a kind of faith-based investor, social outcomes are obviously very, very important to us. But we do see climate change as the number one priority for us as from a responsible investment angle, because of the systemic issue that it has on our portfolio. So at the beginning of the year, we signed up to the UN convened Net Zero Asset Alliance, which is a consortium of big investors that commit to their portfolio to go net zero carbon emissions by 2050, and then there's interim targets in the process. So I'd say the biggest area where we're looking for solutions to is, like Matt said, climate solution investments, and then reducing the carbon intensity of many of our other investments in our portfolio that have previously been kind of difficult to assess from that point of view. Now we're conscious that the environmental piece is not just carbon. There's also biodiversity and water stress and all the rest of that, but that is a lot more difficult to measure and more local level. At the moment, it's easier to assess on the macro level the carbon aspect. So I think that's probably one of the biggest areas for us that we're concentrating on at the moment.
Okay, that's carbon. And Helen, when you're speaking to Brunel's portfolio companies, I mean, what sort of topics are you discussing at the moment? Because you're on the stewardship side of things.
Yeah, so we've been having lots of discussions with companies. At Brunel, we've got 6 priority themes. Similar to the Church Commission, climate change features quite heavily at the forefront of those discussions, given the sort of impact that it has and the interconnectivity to diversity, biodiversity, water stress and other elements like that. But some of the other topics that we're discussing are around diversity, and particularly following the protests that we've seen globally and the impact that it's having on certain areas of society. We've been discussing with other asset owners across the industry and asset managers and providers and how they're looking at ethnic diversity and widening out their coverage and integrating that better going forward. We've acknowledged that perhaps some of the focus in the past has been on gender, and that where the discussions are more difficult, it has been a bit avoided. And so we've highlighted that we'd like to see better efforts in that area going forward, looking at all areas of diversity. Some of the other topics that we're looking at and discussing with companies are around the social, so the S in the ESG, which again has been an area which has been difficult to engage on. There's a lack of information and data. It's one of the reasons that we've joined the Workforce Disclosure Initiative that is seeking to try and get some of that information available to investors and access to assess how companies are handling this area of risk and looking after their staff. And it's looking at things like the living wage and the newly introduced living hours to try and reduce precarious work practices for employees who have been those that have probably been the most hardest hit during the pandemic that we've seen. So the social issues are definitely ones that are starting to emerge as topics that asset owners and investors are starting to discuss more with companies going forward.
Okay, it sounds to me that it's very much business as usual for you on the stewardship side. Nothing's changed since the virus hit. It's still pretty much the same conversations you're having.
Yes, so there were some concerns to start with that engagement might be impacted due to sort of the lockdowns. Actually, in some respects, the reverse has happened because people aren't travelling as often. Some of the people higher up in businesses who would normally be travelling a lot more are increasingly becoming more available. And with technology, it's much easier to have a dialogue with a company in Asia over sort of using these different web-based applications. And so we're actually finding the reverse is happening, that we're able to get greater access to companies and at a higher level more frequently. And also by showing sort of support for companies and offering that leverage to discuss some of the challenges they're facing, we're able to build new relationships with companies that perhaps didn't exist before. So very much business as usual, if not busier than we were before.
Okay, that's interesting. That's interesting. Daniel said that he wouldn't be surprised if his portfolio is outperforming at the moment. But it's very interesting to see how these responsible investment strategies are performing in the current climate. Richard, can you give me a flavour exactly what's happening with you guys in terms of your portfolio? Hello, Richard. If you unmute yourself.
Good point. Apologies. So, yeah, so we don't track an RI slice of our portfolio and put a factor loading against it, but we certainly, I would say, the sorts of businesses that have high RI weightings or would be viewed as good from an RI perspective tend to be the types of businesses we would like, because we would invest in what we would say is quality businesses for the long term, and will have a sustainable business in the long term, sustainable cash flow, sustainable competitive position. And that means as to get to that conclusion, you specifically will look at a whole series of RI characteristics, that they are the right side of, you know, the E, the S, and the G, because these are things that can severely impair a business in both the short and the long term. So we have seen some outperformance. Now, I think I'm always quite careful with any investment performance of any factor to say what's driven that, because it could be due to a genuine driver, or it could just simply be noise or luck or whatever. I think my personal belief that I do see that these issues are going to drive longer term performance. And I think, you know, but you just have to be slightly careful over the shorter horizon, because to say you can have noise and random things happening. But my personal belief is it's the quality, and quality now of quality businesses links into this RI thing. And I think it comes back to this more complicated world in which we live now, where, you know, every enterprise has a social, call it, I don't know what the correct term would be, but some kind of social contract with society, governments and the like. And that contract is evolving, and RI is core to that. And I think COVID has then accelerated that transition now, where significant sectors and businesses are very different today to where they were even just slightly more than 6 months ago, and are relying ever more on the participation and even direct governmental and societal support. You know, this idea of the Pret economy and getting people back into London, all of this type of stuff. So I think, to me, it means, and I'm sure we'll debate this more in a moment further down the line, but that sort of interaction between society, government, corporate enterprise, private enterprise has just got that ever much tighter, and it's now meaning that RI is close to the fore. And I think investors are starting to price that in, to be honest. So companies that are well aligned to that future state are being rewarded. I think that is clearly part of what's driven performance over the last 6 months. So, long-winded way of saying that I think there has been outperformance of RI strategies, and I think there is sensible reasoning for that. And it's, you know, it's pricing in where the world is going to be over the next 5 or 10 years, and these type of things are becoming more important. But it's been accelerated by COVID, in my mind.
Okay. And Matt, would you like to come in there and talk a bit about how things are going on the investment side of your operations?
Yeah, sure. So bizarrely, our portfolios are at a higher level than they were on January the 1st, which doesn't make sense at all when you look at what's the deterioration is in the real economy. And one of the reasons, clearly, if you look at global indices in equities, you've got huge tech stocks which dominate, for example, the S&P, and they've performed fantastically and have sort of are disguising what's going on in headline indices. For us, when you construct a sort of responsible investment or ESG focused portfolio, there's a danger you end up very overweight in healthcare and technology, because those are sectors that often screen well in terms of return on capital, long-term sustainability, particularly the tech companies, although they might have issues on the S, the social side of ESG. They are in many ways at the forefront in terms of the E on funding their businesses with renewable energy and some of the things they're doing with AI to be more efficient. So those two sectors have performed very well. So for us, RI funds were doing well before the COVID because of their exposure to quality sectors, and they're doing well throughout it now because of the resilience of those two sectors. And then just beyond that, we have about a third of our portfolio, 20% actually is in venture capital, but a third is in illiquid investments. So these are funds that are looking at 10, 15-year time horizon. Some of them are based in the US, and they've been so very long term. Our money is locked away, and they've been telling us for 2 or 3 years about some of these trends which were coming, which were very increased working from home, the changing nature of cities once electric vehicles appear, the changing nature of the job market, which technology brings in terms of jobs becoming redundant and new ones being created. And to echo Richard's point, the pandemic has accelerated a lot of those trends. Things which were 5, 10 years in the future are suddenly happening now. So with all the good and bad things that brings.
Yeah. Okay. Thank you very much. Thank you. It's interesting because 2020, of course, as I said at the beginning, we've got the pandemic. We've also got lots of protests around. We've got the instances in Leicestershire with the factories producing clothes, what they call fast fashion, and sort of scandal that's unearthed there. When it comes to ESG, the G, the governance, and the dot, that's always been important. The E, the environment, that's been extremely high profile the past couple of years. But the S, the social side, has always been sort of running behind. This does seem to be sort of this moment. Are you guys seeing any difference here in terms of the social part of ESG, or do you guys think this is a marked change in how that's perceived? That's an open question to anybody who wants to come in there. Richard.
Yeah, I'm happy to comment. I think absolutely. I think that social, as I've touched on earlier, the social contract between private enterprise and society and governments has evolved dramatically in the last 6 or 8 months. And I have to say, you know, I'll be very open and candid. If you'd asked me 3 or 4 years ago, you'd have cut me open, and a pure capitalist. And the way about return on capital, I've almost done a full 180, 360, put me back at the same place in terms of my thinking on these topics. And I think my mentality drove forward pre-COVID, actually, when I think you saw through last year, I think it would have been when people like Jamie Dimon came out and made the comment that I think he said shareholder primacy is dead, or words to that effect. And you start realizing that the world's preeminent, private banker, manager of a very large institution has come out and made comments of that nature. And you start thinking, actually, the world has really evolved, and COVID has just accelerated that. And I was making comments 3, 4, 5 months ago that certain sectors, and specifically airlines, in my mind, I couldn't really see a future for them without that social interaction and society saying these are critical for the future of our functioning. And that would obviously come with terms. Now it's not quite how it's transpired. And, monetary policy has, in the short term, reflated markets. I think it was touched on earlier, that, the point that the real economy is looking pretty dire, but actually markets are looking good. And I think that may have pushed that back a little bit, but I think those social points are critical. And the thing I would point to as well is the impact of social media and the ability for groups to shine a very bright torch on a specific issue, which could be any number of things, but a lot of these are social issues, and highlight a corporate or a government or someone who's doing something that may be against the broad consensus, or maybe seen as immoral, or whatever it is, and that can have a very, very material impact on that entity. So I think that suddenly you can't just say, "Oh, it'll be fine, we'll look through it." It's the transmission mechanisms for people to protest and highlight issues have changed, and that has changed dramatically in the last 5 to 10 years. So I think you have to take those social factors very seriously, and anyone that doesn't, I think, is running, well, significant risk against that, let's just say.
Mm. Yeah,
Daniel?
yeah. I think it's bringing forward a few things. So first, I remember Swiss Re, when the Carbon Disclosure Project came out, they looked at that and they said, that's Annex 1 in the climate change damages case. It's like, who do you sue if you suffer damages? You go for the people who've got money. So even if you don't have a social or environmental bone in your body, if you've got money, they're going to go for you. So I think there's a bit of that on one end of the scale. On the other end of the scale, a hospice is not a discretionary purchase. Elder care when you're old is not a discretionary purchase. Cancer care is not a discretionary purchase. I think we're beginning to see what is important when you face crises in your life. So these social issues that seem fluffy and woolly, actually, they are the hard ones. They are the really, really hard ones when you're up against them. And the question of what does the high street look like? Which bit of the retail sector is moving up or down? Relative to these hard social issues, I think there is something here about what is real that we're beginning to see. I think the second point I'd make is that the world that we live in is one that we've just made up. I think this was something that was observed in the last global financial crisis. The economy is kind of based on confidence, and we've just kind of agreed a whole set of stuff that we think is real, but is actually quite vulnerable and transitory. If you look at the Thames, I don't know how many of you are aware of what the Thames look like, but if you visualized it, it's quite a fast flowing, gray, murky river. And you kind of think, yeah, that's what the river looks like. It doesn't. It shouldn't actually look like it. It should be sitting in a wide floodplain. It should be clear blue water. You should be able to see green reeds on the bottom of it. And that's actually what the environment should look like. So much of what we believe is the actual world that we live in and how it's structured and how it is, that we just believe is the way it has been and always will be, actually is incredibly transitory. So I think things like this, the last global financial crisis, this pandemic, I think are big wake-up calls for any of us who think that the world is a safe, structured place. It gets pretty wild at times. The pandemic, climate change, I think this is, these are really hard issues. We have to tackle
them. Aaron, it's quite interesting what Daniel said there. And I mean, we've already heard about the quality of data, lack of data, especially on the social aspects. What do you think about that? Is the data improving? Do you think what we're seeing this year will be a catalyst for getting better quality data out there?
I think more important than data is just taking a holistic approach to, as an asset owner, taking a holistic approach to what your managers are doing in response to investment. So it's not necessarily that you need to always be reviewing the data of the investments that they have to ensure that they are investing in line with what you are asked for. Obviously, that's important, but more important is getting to know the kind of strategy and the philosophy of the investment manager and having regular talks and updates to see just how they invest and what their thinking is. So I think that's always the most important thing. But then on the data side of things, I mean, data is an issue. Everyone always mentions it, and quite often, we're looking at the wrong things. So if we're talking about social diversity, boards. If we're looking at gender diversity, for example, the gender diversity of a company's board is not really the best thing to look at. If you're looking at gender diversity of a company, you want to be looking at gender pay ratios of the actual workforce, or the ratio between CEO pay and the average worker's pay. So I think that more disclosure when we're looking at the social issues at the actual company level rather than kind of the board level is much needed. And I think probably that sort of data will start to become more accessible. And while this is kind of there for public companies, in private markets it's a lot less available for a number of reasons. But there's starting to be an awful lot of AI companies and big tech companies that are coming out with some solutions to it. So that's quite exciting seeing that.
if I could take us a step back to before the crisis, and what kind of returns were responsible investment strategies gaining? Because I'm assuming quite a lot of them wouldn't have included things like oil and gas, for example, which have been high dividend payers, high growth stocks in the past couple of years. So Matt, to start with you, what kind of returns were you expecting to generate back then?
Yeah, so we target inflation plus 4%, so call it 7% across our whole portfolio. And in the main environment, any strategy has to hit that hurdle. If it's high impact but lower return than that, then it goes into the social investment fund. And so we considered everything alongside a more non-stream, if that's the right word, a non-ESG fund. But the reality, all these divisions have blurred. And in terms of fund managers, everyone claims to have the best ESG product, and there's no shortage of very glossy presentations which all say the right things. But so the diversity of good RI funds to bad RI funds is huge, and we couldn't do it on our own. So we hire advisors to help us with the fund selection, and they really take their time to get behind the presentational element, if you like, and that can include reference calls with former employees, really trying to dig behind the scenes. And typically we quite like boutiques rather than large managers who are trying to invent themselves, so that the people side of it is absolutely key. If you can get a small group of people who perhaps have plenty of experience and have left to set up their own firm and care passionately about that, we would rather back those than a big fund management group, for example, who's been around for many years and is in some ways maybe jumping on the bandwagon. So our expectation, a performance of the funds we have like that has been good, but also our confidence in the sustainability longer term when we look at, for example, the likelihood of key people leaving seems to be lower. They're at a certain point in their career cycle where they often care passionately about all this. So I slightly ducked your question, but good performance is the answer.
Yeah, Richard, same question to you. What sort of returns were your RI investments generating before the crisis hit?
Yeah, I think so I'd say the most visible part of our portfolio is our global equity portfolio, which is just under half of our clients' portfolios, and that is run with a quality bias with a integrated ESG integration type framework. And that then leads you, as I think was touched on earlier, to some of the sectors bets that you have in there, so there's tech, healthcare. But it means that we've avoided certain sectors as well, and you touched on energy. So we have we have an RI policy as a company, and there's a climate change annex essentially that's specific to climate change. And that means investing in any extractive anything that's extractive or is very challenging for us. It means we're going to be very underweight those sectors. So a chunk of the outperformance that you saw, and I'm sort of repeating a point that was made earlier, that all the performance that we're seeing now is simply due to the sort of sectoral weightings of what is driving markets. So being underweight energy for a while has been quite helpful as oil prices came down, and so so a big chunk of the outperformance of certain strategies is simply, I suspect, the underweights to those strategies, and now the overweights, as was touched on, to healthcare and tech. So that's a big chunk of that. But as I said, I do believe that I don't believe that is simply noise, if that makes sense. I do think that is also aligning with the longer term transition as well. So some of that has been helpful because the way the cards have fallen of late, but I also think there are longer term drivers for that. So I do think that, again, it comes back to, in my mind, as a long term investor, you want to focus on quality investments, things that have sustainable cash flows. To think about the sustainability of the asset in the long term, you have to think about risk to that asset defined very broadly. And within that, there's a whole series of what you might call traditional risk measures. And then there's a big box or bracket of things that would be ESG and RI. And those are things you have to take very seriously because they manifest themselves over time. And they're core now to the investment case that we put forward. And these are, and it isn't just global equities, as I think was touched on. This is across the whole portfolio that these things are coming to bear. And the way I've talked about this in the past is to say, now let's take climate change as a specific example. People can argue back and forth on the science. They can argue whether you believe that climate model or that climate model. In my mind, it doesn't really matter anymore. The train's left the station, in the sense, and what I mean by that is that this has been priced in. societies are moving in this direction. It's going to be a very long time, in my mind, before anybody really knows whose predictions are correct. It's way beyond my career, probably. So the reality is society is moving in that direction. The legislation is moving in that direction. Taxes are moving in that direction. So you have to align yourself with this. And it's the same in many of these other things, that even if you are a non-believer, you still have to invest, because it's not, in many ways, in investment, certainly in liquid markets, it's not what the truth is, it's what the perception is and how things are being priced. See, you could be totally right on the facts, but if the market perceives it in a different way and it plays out in a different way in the market's mind, you're totally wrong from an investment perspective. So you have to think about that. So I come back to that. I can see there has been significant outperformance for a number of these strategies. I think you can be mindful as to what the real drivers of those are. Is it coincidental sector weightings, or is it something more meaningful? But I do believe in the longer term, investors need to be very mindful of these factors, because I do think it will impact long-term performance.
Daniel, do you want to come in there and add something to the returns?
Yeah, I mean, we don't, in big issue invest, we don't deliver returns close to the conventional marketplace. On our investment funds, we have 3 social enterprise investment funds. We're looking at a 4 to 6% return to investors. And essentially this is, it's debt with an equity-like risk. We're well off what you would get on an SME debt fund or a venture fund. On our direct lending side, 3 to 5% return to investors perhaps is what we can do. And the core of it is the underlying things we're in. There is not a lot of margin I say this with some caveats, but for example, if we have 750,000 homes in the private rented sector that are not fit for human habitation, out of 5 million or so. So what's your margin for dealing with those properties? So your income is local housing allowance, which is set by government, that's paying people who are not otherwise able to afford housing. So there's a fixed set of income there. There's the value of whatever you put in to renovate the property that you're taking over. So your margin is that it's tight. If you're in the care business, it's a tight margin. We can do all kinds of things to say, do some of our models around cooperative ownership of care providers, reduce staff turnover and improve profitability. But you're into that classic, you're into your value is from the very careful management of the organizations that you're investing in to deliver value. But we're well off the kinds of returns that most investors expect for us, which is a challenge in growing the impact investing market. Because if there are 750,000 homes that need fixing up, that are unfit for human habitation, that's a very large number that you start looking for, and you must be paying a market return to raise that kind of money. So our challenge is proving a model that might get towards investable return for the mainstream.
And Aaron, can I just ask you about the church? Are you guys targeting any particular return here, or is it just making money and doing some good and making sure you're sticking with the ethics?
Yeah, so we have a returns target of inflation plus 4.5%. We've recently changed that, but that's our target over the long term, inflation plus 4.5%. We are a fiduciary investor, so we have fiduciary responsibilities, and even though we are an endowment backed by a faith-based organisation, the legality of it is that we can't make any concessional investments. So everything has to be looking to get a competitive market rate return. So that, as Daniel was saying, that makes a bit of a problem when we're looking for pure impact investments. I'd say when we're looking at ESG and other responsible investment integration, we think that can enhance investment returns in certain areas, and impact monitoring and impact investment can also enhance investment returns. But I think the difficulty with impact investment is that not everyone is speaking the same language. So a firm like Daniel's is looking very much at outcomes based investments and trying to really push the bar and delivering real catalytic capital and real change to people's lives. And then on the other end, you've got kind of big private equity houses that are raising kind of side vehicles that have an impact kind of lens, but effectively are really just kind of taking deal flow from other areas of the portfolio or other areas of the firm and looking at it from an impact perspective. Now, it's good that they're looking at impact. It's kind of the direction that we all want to go. But the difficulty is that we're speaking about kind of two different areas of the market. And then when you've got a kind of job title like mine, impact investment, and we're looking at kind of trying to get as many impact investments in the portfolio as we can that meet our returns target, then you get an awful lot of kind of confusion of people coming to us or what we exactly want. So there's a difficulty there across the spectrum of capital that Matt talked about earlier, but it is moving in the right direction. There's a lot more deal flow in impact than there was even when I started at the commissioners. So there's got to be a positive.
Got you. Thank you, Aaron. Helen, from what we've heard here today, I mean, Daniel and Aaron are unlikely to ditch their principles, and Richard and Matt are very much still going forward with responsible investments. Are you seeing any evidence that when times are tough and companies are facing big decisions, that maybe some companies are sort of stepping back on some of their commitments, whether it be the environment or social?
So there's no doubt that during the pandemic, companies have had to focus on sort of their short-term dealing with the crisis. And we have seen some sort of barriers been put in place in terms of sort of policy, some of the policy that companies might be looking to implement some of their strategic objectives. So obviously COP26 has been delayed until next year, but then that presents an opportunity for us to learn from what's happening at the moment, the supply chain management issues that companies have faced and the challenges. And it's almost an indication of risk factors that could be to come if they don't deal with the challenges of climate change. I don't think we've seen a resyndication of companies pulling away from their objectives and strategy that they've set. We've certainly seen in the last few weeks several large announcements from sort of BP and Unilever on sort of long-term and interim with targets along the way. And really sizable changes where we're now seeing companies allocating capital expenditure to their announcements that they've made. I think part of the challenge that we're going to see is not whether companies are pulling away from the what they've set, is whether they go far enough in dealing with the risks and opportunities that they face, and getting under the bonnet and analysing, is it a meaningful what they've announced, or are they playing lip service? But I think in the long term, companies are realising that if they don't deal with these risks, it's going to hit their bottom line and it's going to hit their long term sustainability. Just because we're in a pandemic doesn't mean that climate change has disappeared. It's still a very real risk that we're facing, and we need to deal with that problem and implement the tools to make companies as sustainable as possible.
Passive investing is growing at the moment. More and more investors are going down passive routes. How does that work with the sort of the ESG responsible investing way of things in terms of engagement? Because engagement, as we've heard there from Helen, it is quite a big thing. It's quite a big issue. It's quite a big part of it. It's getting in and speaking to management, making a change. How does that happen if you're passive? Is it possible? Is it just you've got to put up and shut up? I mean, Richard, can you come in and explain me how that works?
Yeah, well, we're very much in the active camp, and I buy the arguments for passive investment, and I see the challenges as well. And the way I would normally frame the whole passive debate depends on who you are and what scale you're operating at and what your objectives are and what your costs are. So for certain groups, so retail investors, I think passive investment makes a huge amount of sense because you can't access investments directly at low cost for various reasons. As someone who looks like us, where we can have a team in-house doing active investment and genuinely looking at the full detail of the business in a thoughtful way and doing the granular work, at scale, and we can drive down essentially our implementation costs to close to a passive level, or if not potentially lower, but that's a very contentious statement. I'm very much in the active engagement camp, because I think that the challenge with the passive approach is we've seen examples, so I quote Boohoo recently, where certain screens did not flag some of the issues, where I suspect more diligent, and it's not a name we went near, we didn't do the work, but I can imagine some of those issues may have been found by people doing discretionary work themselves. So I just think the whole passive versus active debate, to me, the key is there's two elements to it. One is if you can implement in a way that gives you confidence that you are having that genuine focus to make sure that you're not simply just doing screens. I think there is value, because it can drive down unit operating costs, you move some of the subjectivity. But the other challenge is, even when you engage, it's getting over this, but are you going to sell? How's that going to work? Whereas our discretionary managers can be, when we decide to get out of a name, we will unload it, and because of if you're a discretionary manager, people know that the management we talk to, you ultimately have the nuclear option. Whereas what I've never quite got my head around is how that engagement works in a passive world, where you don't have the that ultimate trigger pulling ability to say, you know what, you haven't convinced me, you haven't given good reasons on these key issues to me, we're done. And I don't know how. I've not been given confidence yet on how that works. And maybe there are. I'm much more comfortable personally being in the active camp, where we can do that, but it is executing at the right cost.
Matt, what about you? Do you have any passive investments? And so how does engagement work for you?
No, we don't have any passive. I mean, in order to do engagement, you need focus, and passive are obviously the ultimately diversified funds. Having said that, we are increasingly looking at tilted passive funds, which I know have been around for a while, but particularly on the environment side, we're looking at a type of, I'm loath to call it passive, because there is quite a lot of deviation from the benchmarks, more a sort of smart quant fund in a way, which screens out the things we don't want to hold. The fee is obviously attractive, it's very scalable and liquid, and with the fund we're looking at, they've actually have an engagement program with a third party, which is quite interesting, and I would really hope that some funds look at that over the coming years, this idea that we essentially don't want to give money to funds that just run our money for us. We would like an engagement of some sort. But then having said that, climate change is an interesting one, because the majority of damage, if that's the right word, the historical carbon emissions have been done, 75% have come from 100 companies. So even though you have a very diversified fund, you could, in theory, have quite a smart engagement program, which really targets the companies that could have the biggest impact. It's not perfect. And you also have that industry effect, where if you could engage with one company in an industry, its peers then start to think they need to move forward as well. So I don't think engagement via a passive route is a non-starter, but it's certainly more challenging.
Gotcha. I think we might have lost Daniel there, but I'm sure he's coming back. Helen, in your experience, is engagement just something you can do with an active investment?
And engagement in active investments is certainly sort of an easier route. You tend to have less holdings and more direct routes to management and ongoing engagement. So actually going to come in on the passive point. We do hold passive portfolios at Brunel. And yes, there are challenges around the fact that you are holding that position, and when things go wrong, you're still holding that position. But a lot of the passive providers are very large. And with that comes scale and access to some companies that actually through an active route might be more challenging. If you're representing 5% of the vote at an AGM, the company will want to talk to you and hear your viewpoints. And I think we are seeing some progress being made in the passive management space and understanding the requirements from their clients and customers. So we obviously saw announcements from BlackRock earlier in the year, who've come under criticism in the past for their approach. They've now joined up to Climate Action 100+, and we've seen them vote against 53 companies this year on climate change and put another 191 on watch. So it'll be interesting to see how the managers develop over sort of the coming years. There are other elements you can do as well. So you can look at, as Matt explained, tilts or alternative benchmarks to look at what avenues you can take. But also it's important to realise that, particularly as a pension fund, we're a universal owner. So just because you have an active fund and you may only be invested in 30 companies doesn't mean that they might not be impacted by the actions of another company. So having that holistic view and looking across the universe on how the companies are interacting with one another and the impact is quite important as well. And we gain that lens through the passive as well.
Gotcha. Okay, so it's not a complete no-no. Of course, I have met asset owners before who have told me we're pulling out of passive because we want to be more hands-on with our investments. So it's not as you say, there's not a complete no-no. Okay, change of tact a little bit now. We are in difficult times, and a lot of industries are struggling in the economic uncertainty, and many of those industries are going to the government for help, as the banks did 12 years ago. I'm thinking here especially airlines. Is this an opportunity for governments to start setting down some targets and changing business practices for some of these industries? Daniel, is this a good opportunity to sort of implement some change on an environmental, social aspects?
It is, and I think Richard put it very well about the social contract is the awareness of it is stronger than ever, and it was prior to 2008. I mean, there was for decades, I think. You had people jumping up and down saying to the banking system, look, there is a social contract, because if you ever do get fundamentally threatened, the taxpayer will be there and does stand behind you. And the banks kind of nodded and carried on. And 2008, that social contract was called, and the taxpayers of this country stood behind the banking system through all its institutions. I guess there is this bit about can we pick winners in our portfolio, and that would be the thing that we'll be asking government to do. That would be a wrong way of thinking about it, and that's the debates we're having about state aid at the moment. That worry is so clear that if government believes that it can pick winners in a sector or in the economy, then that would be a bad way of approaching things. But the whole Green New Deal, green recovery, if you are going to stimulate the economy, yes, it just makes huge sense to get the hundreds of thousands of small builders running around doing energy efficiency and doing things that are relatively cheap in terms of the climate change impact. So there are real sensible ways of delivering job creation and economic growth through a green economy. We absolutely should be doing them. I guess it depends whether you have any confidence in this government's ability to do that. That's a wider point. I hope they are up to the challenge we face.
Aaron, is this an opportunity that the government shouldn't waste in terms of implementing quite a lot of change that otherwise might have taken years to achieve?
Yeah, definitely. I mean, I think a lot of webinars and talks and stuff when the COVID crisis first hit were talking about the missed opportunity of 2008 for a green stimulus package, and now there is the opportunity for green stimulus packages and with attached caveats. There's the whole Build Back Better movement, and I think that's a role that investors can take in signing up to these sorts of things, and pushing on governments, especially our government, to enact the right policy. We got COP26 coming up in this country next year, and that's the perfect platform to be able to do that. We're very much of the opinion that there's no shortage of capital wanting to go to climate solution or social solution investments or anything like that, as long as everything is priced correctly. And at the moment, externalities, whether be they positive or negative, are not priced appropriately. And as soon as they become appropriately priced, then investors can start, and commercial investors can start making the right investment decisions. But at the moment, government investors are almost being forced to make inadequate investment decisions because externalities are not appropriately priced, and they can only be appropriately priced by government.
Okay, good. Would anybody else like to come in there and add to what we've already heard on?
Yeah, I mean, one of my biggest failures ever was a grant actually at Esme Fairbairn, where I used to work, where Matt works now. We put, I think it was 420 odd £1,000 into a green tax commission, green fiscal commission, and this was, and it turned out we used Cambridge econometrics, and at a zero net cost to the economy, you could get a further 10% reduction in greenhouse gas emissions between 2010 and 2020 by shifting green taxes, I think, from about 7% of tax take to about 17% of tax take. I mean, this is sometime in the past, so the exact numbers are well out of my head. So it was like a free cut in greenhouse gas emissions. It landed on the Chancellor of the Exchequer's desk in 2010 when they entered government, and it disappeared. Because green tax is the one thing that gets you on the front page of the Daily Mail, and this is not a pleasant story that you will have. I mean, this is Aaron's point exactly, that things like green taxes that change price are really essential tools, and we're not using them as a government, as a society. So there are really effective tools for us to use. And these things can be brought in gradually, long, slow signals in the economy. The tools we need are there if there's political will to take them. And it is not easy for our politicians to take up those tools, I fully accept.
Okay. Richard, you're on mute.
Sorry, coming in, Daniel, the challenge on those, though, is that's the E discussion. But then what I always think is you cut into the S component, because if you put in green taxes, it doesn't land on every individual or every stakeholder group the same. So if you're not, the problem I think you always have is that for many people involved in the sort of discussions, however you want to build the cohort in certain elements of society, a green tax on your electricity isn't going to make that much difference, but to certain cohorts it makes a massive difference. And that to me is always the problem, that with all of these things, that the green solutions are great for those that aren't sensitive to a few cents on a tax rate or their fuel or whatever, but for many it's very material. And that's the bit I think we keep the challenge we have with these discussions, that you solve one issue, let's say the E with green taxes, then you crash straight into the S bracket, that it's then falling on whether it's pensioners or the lower paid or whoever. And that's the challenge I think that we face, is trying to find that right trade-off across the spectrum. And I don't have the answers. I'm not smart enough.
Well, they are there in them. I mean, there's a whole benefit system that we can pick up on, winter fuel allowances. They're all, I mean, I completely agree with you. You can't just bring in a green tax. It has distributional effects. And part of that commission was looking at those distributional effects and looking to find ways of compensating the most vulnerable losers, and even the noisiest losers in those things. So you're absolutely right. I mean, you pull one thing, it hits something else. But it's like green taxation it's such a useful tool that is so underutilized. Because what can you do? You can regulate, or you can try and convince people out of the kindness of their heart to do something, or you can change the price. And it's that ability to change the price that's kind of untapped in this. I completely accept your point and support it.
And I fully agree on the impact of price being the most powerful lever. And in a way, I joke, we're all Keynesian now in terms of stimulus and getting things moving. So.
Yeah.
Okay, guys, we are actually almost at our cut-off point, so we've not got long to go. So I think we'll just turn now to the final question now, which I'm sure a lot of you have had a lot of practice over the past couple of months rehearsing, I'm surely. It's what will responsible look like post-COVID, when the virus, we found a cure, or the virus is largely being eradicated and we're getting back on with our lives. And what will responsible investing look like? Does anybody want to kick us off there with that?
I'm happy to speak. So what it looks like post-virus, I think it'll be more of the same. I just think it's almost like a step function. These factors that they started off quite low, say 10, 15 years ago, whatever it was, they took a ratchet up. pre-COVID. COVID's ratcheted up the impact, the views on many of these factors in people's minds, in processes, and I think they're going to stay there. I think the acceleration has been a step change now, and it will continue to creep up through the next decade or two. And I would always frame these things in terms of cycles, that we're now moving through a series of political cycles and political stakeholders. And you can trace the behaviours we're seeing today back to what you might call the greatest generation, the pre-war, then the boomers who are in political power now, or just coming out to. I'm sort of in that, I'm in my 40s. When you see the younger generation who are born, say, post 1980, say 1985, coming into political power, where many of these beliefs are truly native and they haven't had to learn them as they've grown up, I think you'll see another acceleration of change in how important these things are coming into society. So to summarise, I think you'll see more of the same, a slowdown, but potentially an acceleration in, say, 10 years' time.
Gotcha. Daniel, what about yourself?
Yeah, I think looking back over challenging economic times, there's tended to be and I caveat this with this is a general statement. I haven't got a firm evidence base of saying this, but it has seemed to me that every time we've had a recession, there's been an upsurge of interest in responsible investing, because people have said, I want to do something. And what can they do in this in a big economic crisis? But actually moving their money and saying, well, I'd like my money, my pension, my savings to do something positive is an action that people can take. So I would expect to see an increase in interest in responsible investment out of this pandemic. I agree about the long trends. It is my cousin's wife said to me, Daniel, where's your escape country? And I said, what do you mean? You know, what do you mean about my escape country? He said, my escape country is Colombia. Where's your escape country? I said, but Carol, what are you on about? So Carol is actually, her family went to the United States 70 years ago. They fled fascism. And the idea of an escape country is really real if you come from a particular background. So I think we're at a moment of worry. It's been a concern to me that what am I doing talking about racism and discrimination and equality, and let alone gender equality. This was my mother's battle. My generation's had to fight it, and the next generation is walking into it. So I'm torn between a great optimism that yes, we're moving in the right direction on responsible investment because we must. It's an existential need to be responsible in our investment, and some concern that we're still fighting the same battles. But then, as a final point, I suppose it made me feel that perhaps I've just been naive about progress. I thought about progress as a horizontal. You push along, you make progress. You push along, you make progress. And actually, maybe progress is vertical, that if you push, you make progress, but if you stop pushing, you fall back. So maybe it's simply that we not only have to build on all of the progress that generations have made, but we just have to keep pushing, or we fall back.
Matt?
Yeah, sure. So we signed up to the UN Principles for Responsible Investing in 2014, and we wrote to all our fund managers, of which we have quite a few, and explained what it was and what did they think of it and were they doing it themselves. And the global managers gave us very good replies. The hedge funds also gave us good replies, and the sort of venture capitalists we never really heard from. I'm generalizing a bit. So we then sort of screened all our managers and put them at the bottom of the list in terms of, these guys are not good. The reality is that when you then actually, go meet them and they say, yeah, sorry, we lost your letter. What's this all about? And you explain, well, this is about, we want in your portfolio for you to find good companies that don't have environmental liability, and they invest in their people, and they're not just focused on short-termism, but they can actually look at a 10-year time horizon. They might look at accreditations for being a good quality company, or thinking about their external stakeholders in the environment, et cetera, et cetera. And one of the managers sort of said to me, well, yeah, but that's just good long-term investing. That's just what we do. And for me, nothing has changed in that regard. COVID is a very difficult time, but we difficult times in the past, and good investing still looks like good investing. The themes are different, and to Daniel's point as well, politics unfortunately has never been so key, particularly the US election and where we stand on the environment next year can go in two completely different directions. But in a way, it's still, if you can genuinely focus on a 10, 20-year time horizon, where we're going hasn't changed. The acceleration, it's brought quite a few things forward. Perhaps peak oil demand, which might have been in 2023, has already passed us by. And then interestingly, financial markets, for all their flaws, may be the lead indicator. So and the insurance industry is the key example, because they look at a lot of these things. For example, if you're building a property now by the sea funded by 30-year bonds, the cost of to insure that every year is just going to go up. Have you actually priced that in? There's buildings in Florida where the insurance may become completely exorbitant in 3 years' time, or the insurance market might disappear. So that's before the physical effects have appeared. The financial market is already saying it's too late. I think people are underappreciating that moments like that could come as a shock before the physical effects are seen, and the trajectory of increasing frequency of physical effects is rising anyway, so that will eventually impact through to voters and particularly the next generation, as Richard said. So I'm optimistic.
And Aaron, the church, of course, nothing changes with you guys. You've got your ethical approach to things. Do you think that the times of living are all harder to resolve with other people outside of the church in terms of responsible investing?
I'm in the optimistic camp as well. I think over the last year, the amount of companies taking just climate change again as an example, the amount of companies that have signed up to net zero commitments, and it's one thing to sign up for a net zero commitment, but another thing to put a strategy in place. The number of companies that have put strategies in place, science-based targets in place to deliver on those net zero commitments. The last year has just seen such an upswelling of companies that are committed to, we've got Shell during the COVID crisis, for example, and, that's just such a big signal when they sign up. You've got an oil major sign up to a science-based target to be net zero by 2050 during one of the biggest recessions that has ever seen. I think just shows the seriousness of the issue and how serious they take it and how serious a problem it is. So I think when the trajectory over the last year has just been phenomenal from that point of view. But I think Daniel's point is really good, that unless we continue pushing progress, then I think that there's a tendency that it may stop and say that that's good enough. And I think that investors, as the asset owners, both from an institutional and a retail perspective, have such a big, powerful voice to push that curve up. And I think that isn't going to go away.
And Helen, and part of the stewardship team engagement, you're on the front line, of course, change. What are you expecting to see from responsible investment attitudes towards it going forward?
Yeah, I agree with the comments already made. I'm quite optimistic that we'll continue to see responsible investment growing and more parties participating in engagement. The PRI launched their active ownership 2.0, and we're seeing more collaborative engagement amongst parties. I think there's a growing awareness that for some of these challenges we can't do it alone, that we need to work together to do it. And in terms of some of the themes that we'll probably see emerging post-COVID and certainly emerging now, continued scrutiny over executive remuneration, particularly where we've seen company staff put on furlough, but big bonuses still being paid out. We'll also probably see more focus around tax. With the shift of companies to online, there's obviously big debates going on in Europe around tax for companies operating online versus those on high streets, but also for those that operate precarious tax practices that have had to utilise government sort of support during this time, sort of assessing what they're doing going forward. And we've already seen some companies announce that they intend to pay back the furlough money that they've been given as support during this time. I think tax and sort of getting some of these existential risks, climate onto the books and through audit will be more increasingly important going forward.
Okay, thank you very much. And okay, guys, we're up to the cut-off point now. So unless anyone's got a final comment they wish to make. Thank you very much for your time, guys. It's been great. We've got quite a diversity of topics we've touched on there within responsible investment. It just shows how broad and vast this is as an investment strategy. So thank you very much for your time, guys. I look forward to catching you again soon.